I'm speaking with Morgan's Chief Economist Michael Knox about UK election results. Michael, yet again, investors are having to grapple with a surprise election result, this time in the UK, where a hung parliament has just resulted in Theresa May forming a minority government, which was a huge surprise for investors. What exactly does this mean for the UK economy, particularly with respect to Brexit?
I went to a presentation in Chicago in January as part of the American Economics Association annual convention. And one of the many panel discussions I went to was one on Brexit. And there was a very good presentation by Andrew Lillico of Europe Economics. And he noted that at the moment, 40% of all UK trade in goods and services, 40% of all exports went to the euro area. And 60% were outside it. He said that by 2030, the proportion of British trade within the euro area would have fallen to 30%. And so what was really interesting about that is that, firstly, British growth in exports outside the euro area, outside the European Union, has been growing faster since the beginning of this century than exports within the European Union. So already what you're seeing is that the euro area and the European Union are underperforming as target markets in international trade, even for a country within the system like the UK. Andrew Lillico said that when Britain leaves the European Union, now let's take the case of the agreement goes nowhere. There is no trade agreement after 2 years, and the discussions have gone nowhere. You get to a situation where Britain then is a most favoured trading nation. It's regarded as such under the World Trade Agreement. In that circumstance, it faces a 10% tariff on its exports. And it has a 10% tariff against European exports. What's really interesting about that is that right now, Britain is the largest export market for German cars. So is that more damaging to Germany than it is to the UK? If we then look at that situation and we look at the fact that most of British exports are outside, what Andrew Lillico said was that in the post-Brexit world, when Britain has actually left, Britain only has to do half as well in negotiating new free trade agreements with countries outside Europe as it has to do to make up for the losses, all of the losses that it's made inside Europe. And we already know that the Americans want to have an accelerated free trade agreement with the United Kingdom. We already know that we in Australia would like to have an accelerated free trade agreement with them, and the Canadians as well. Interestingly, what Andrew Lillico pointed out is that's also true with the United Arab Emirates and Saudi Arabia. So there's a whole bunch of markets which Britain will very rapidly have free trade access to, which it doesn't at the moment because it's part of the euro area. So what he actually estimated was that if there was little agreement, then what would happen would be that the gains outside the European Union could be even equal to or even slightly greater than the losses within the European Union. The second issue with Britain right now is, let's just say there's no government at all, functioning government for the next couple of years. What would actually happen in that circumstance? What would Britain actually fall back on in terms of its international trading institutions? Rutger Dornbusch, who was the great world expert on international financial economics in the 1990s, gave a series of interviews about the results of the European Union and what would happen if various countries went into the European Union or went into the currency union what happened if they would go into the euro. And he was particularly concerned about what would happen to Italy. This is in the 1990s, He had some kind of foresight. And he said that since World War II, Italy had had the best performance of any industrial country in terms of accelerated growth of any industrial country in the post-war period and in the euro area. And that was for two reasons. And it happened in spite of the fact that Italy really didn't have a functioning government for most of that period. Like the central government just kind of changed hands like a couple of times a year. But Domber said there were two things that made sure that the Italian economy grew quite well. One was the central bank, and the other was its flexible exchange rate. He said that the Italian central bank was really good in terms of the Italian business cycle. Then whenever the Italian business cycle would slow down, the Italian central bank would cut interest rates. The result of that was that the flexible exchange rate would fall, and then Italian exports would be cheap again, and then there would be an expansion in the Italian business cycle, and Italy would take off again, and therefore reap the benefits of its very superior industrial design and that kind of thing that the Italians do. So those two things, those two advantages that Italy had in international trade, made the economy strong in spite of the fact that there was really a non-functioning government. So let's just say Britain functions like Italy for a couple of years. Let's say there isn't a functioning government. In that case, it falls back on those institutions of the Bank of England, which has been, is the second oldest central bank in the world. It's been around since about 1670. And so it's a very, very solid and trusted institutions. And it has sterling, which is a flexible exchange rate. So even if there wasn't a functioning government, what would happen is when the economy slows down, the Bank of England will cut the bank rate, sterling will fall, British exports will be cheaper, and the economy will grow again. So what we see then is from the long-term view, which is Andrew Lillico's view, that Britain has more trade opportunities outside the European Union than inside, because most of its trade is already outside the European Union rather than inside. And secondly, it has strong institutions, such in the form of the Bank of England and sterling, which will make sure that the economy keeps growing. So the doomsayers about the British economy may be disappointed again, Tom.
Sure. Michael, notwithstanding the strength of these institutions and the UK economy as it stands, what do you think the impact will be of potentially a dysfunctional government arrangement or a hung parliament arrangement on investor confidence and therefore pricing of UK equities in the region?
Well, it's kind of interesting what the response to Brexit has been, that it's been remarkably muted. Andrew Lillico, in his presentation, pointed out that at the beginning of last year, the International Monetary Fund had said that sterling was the most overvalued currency in the world. It was very high relative to its purchasing power parity. And he said that a lot of the fall that happened as a result or after Brexit probably would have happened anyway. And we've had another sell-off in sterling now as a result of the election. But maybe that was going to happen anyway. Maybe that was part of a process to restore Britain to its earlier stage of, to a better stage of comparative advantage. And maybe what we're seeing is those really strong institutions in the central bank and in sterling functioning again to support the UK economy in the same way as in a previous era, independent institutions in Italy did the same for the Italian economy.
Sure. And one last fearless prediction, Michael, your outlook for the pound in the short and medium term?
Oh, well, sterling is going down in the short term, and it needs to restore the British comparative advantage in trade. My guess is we'll have a bottom in place in sterling by the end of the year, and it'll be stronger next year. But exactly when, we'll have to wait and see, Tom.
Sure. Michael, as always, terrific insights. Thank you for your time.